Good morning. It is Friday, June the 5th. Here's what's on the agenda. Stocks drop as the AI mania fades, at least for now. Brought back to earth, SpaceX will not be fast-tracked onto the S&P 500. And it is Jobs Day in the US, with Fed rate hikes in the balance.
Well, Tom, as questions are raised about the durability of this AI rally, we have seen losses of nearly 7% on the Kospi this morning. And what happens in Korea, as we know, doesn't always stay in Korea. This is a bellwether for AI. So we're looking for even more losses on the Nasdaq today. Futures down 1% as things stand. We'd already seen losses yesterday off that disappointing Broadcom outlook. And then we've got to factor in the geopolitics as well. We had optimism about a US-Iran deal because of the optimism around talks between Israel and Lebanon. But today we're seeing oil up 0.25% at $95.28 the barrel. The countdown to the opening trade starts right now.
Well, good morning. So, some of the steam being taken out of the AI rally then. You're seeing that in the US, you're seeing it over in Asia, as Lizzie was pointing out. Nasdaq futures right now, Nasdaq 100 futures pointing potentially for a third day of losses. You saw Broadcom was a factor, certainly yesterday in the US session, bringing down and pulling lower the broader semiconductor space that, of course, has seen those significant run-ups. Are we seeing some resilience maybe in Europe? European futures are currently pointing modestly in positive territory. They're essentially flatlining. Maybe Europe is where you want to be in this environment. It's worth noting that there was a rotation into the Dow Jones industrial sector and index, Lizzie. So you saw names like Boeing, like Caterpillar, but also the banking space gaining pretty significantly, and interesting, the asset managers as well. And we'll dig into that story. The likes of Blackstone, the likes of KKR also rallying in the session yesterday. So it wasn't a capitulation, but there was rotation below the headline level when it comes to the US equity story.
Yeah, you wonder if part of that rotation comes back to the resilience that we've been seeing in the jobs market. And we'll, of course, talk about the data that we're going to get in the form of payrolls later on. I'm also wondering whether this sort of correction is actually quite healthy. Look, it's not that big a deal considering just how much AI has been taking off in recent months. Is it actually something that would be healthy to have a bit more of a correction today? As you say, we're looking negative for the Nasdaq 100 today. Just in terms of the Korean moves, optimism still dominates when it comes to Korean stocks. Banks still upbeat on chip earnings. Goldman raised its Kospi target just this week. Yep. So we need to have some context when it comes to the AI mania fading, not just eroding.
That context is important. The Kospi down 5%, but again, within the context of almost 100% year-to-date gains for that index. Jensen Huang is on the ground in South Korea, talking up the prospects for including that high bandwidth memory, approvals in Vera Rubin as well. So we continue, of course, to watch that story. The other story, of course, that continues to dominate our attention is SpaceX and the details around that listing. It's being pitched aggressively now by its investment banking supporters in the US. We're getting some pretty wild revenue expectations pushing out until the end of this decade, but also some detail in terms of what happens, including its inclusion into particular indexes and the S&P kind of drawing the line at some point.
Yeah, this is pretty wild that the S&P is not going to grant fast entry to the index for the likes of SpaceX and these other mega IPOs that are on the docket for this year. It's not going to shorten the 12-month seasoning period for newly public companies, which kind of makes sense in the sense that adding IPOs too quickly could create a lot of volatility. But on the other hand, it seems weird to me, Tom, that you're not going to have trillion-dollar firms and all of their economic significance reflected in the S&P. And, you know, to not have the biggest IPO potentially in history not in this index for maybe a year just seems very, very odd.
Well, therein lies the tension, doesn't it? The economic significance of companies like this, of this size and scale, even if they don't meet the particular calling off period, the 12-month period, the profitability tests as well, that the S&P puts around companies like this, the concern for many is, of course, that that passive flow will, by necessity, get exposure to a company that hasn't met those tests. So that's the counter. But yes, there is that tension, isn't there? But the S&P index managers and providers are currently, right now, drawing a line around that, putting out that press statement yesterday. You mentioned the job story, so that is the macro picture for today. That is the build-up. We've seen that through this week with 3 sets of US jobs data, and it's the big one with non-farm payrolls then later today. The expectation is that you're going to get a print of around 85,000. That's pretty weak in the context, of course, of what we've seen in recent years, and an unemployment number of 4.3%. The importance is what this number does, whatever the number is, to the expectations around the Fed, because traders are it's finally balanced right now in terms of whether they think the Fed goes with a hike this year under Kevin Warsh or they hold the line.
Yeah, analysts saying that the risks are skewed for the markets heading into this. So if it's a strong report, yields will go up a bit, but we could see a rally if it's a weak number because, as you say, traders betting on hikes in the next 12 months and higher yields. So watch out for lower yields, given just how bearishly traders have been positioned heading in. In terms of the latest Fed speak, we had Tom Barkin yesterday saying that he hasn't seen any change really in the job market, and Mary Daly saying that it's actually in a good place and calling for cool heads and patient policy making, actually. So, as I say, you could also say that this is part of the story that's feeding into the tech rotation as well, the macro feeding into that. And
you broke down the numbers for us at the end of your show in terms of the layoffs, of course, that have been made across the tech names. But the data out this week, JOLTS and ADPs, have suggested that the US labour market, at least on the headline level, is stabilising. And if you look at the growth metrics and you look at the infrastructure spend and the impulse that's coming through from AI, it does raise questions about stronger growth, maybe a higher inflation picture. We're certainly seeing that, certainly above the Fed's target, and a stabilising labour market. Does that compel Kevin Warsh and the Fed to go with a hike this year? So that data is going to be potentially very significant for these markets. OK, well, let's tell you what's coming up on the show today. We'll be speaking to Colin Lancaster, Global Co-Head of Discretionary Macro and Fixed Income over at Schonfeld. We'll also have Remi Olu-Pitan with us, Head of Multi-Asset Growth at Schroders. Christian Mueller-Glissmann, Head of Asset Allocation Research at Goldman Sachs, will join us. And we'll talk private credit with Alberto Gallo, CIO and co-founder of Andromeda Capital Management. Here's what else we are watching throughout the day. The EU Western Balkans Leaders Summit, where EU Commission President Ursula von der Leyen is due to speak. We're watching that event. And at 9:30 a.m. UK time, we're going to get the BOE's Decision Maker Panel Survey, 9:30 a.m. UK time. Key jobs data, as we've been discussing, out of the US with non-farm payrolls, of course, and unemployment data. That is at 1:30 p.m. UK time. Of course, our US colleagues will be covering all of that for you. And at 4 p.m. UK time, UBS CEO Sergio Amotti will be speaking at the Swiss Economic Forum. And at 7 p.m. UK time, the Bank of England Governor Andrew Bailey will be speaking in Scotland. Lizzie. Well, the other thing that we're watching is private credit, and really the rally can continue. Is the golden age really over? Because we had all of this news back in March, and then it seems to have been picking up in pace again in June. We've had the Cliffwater Story Partners Group yesterday saying that it's ready to get even more evergreen funds, and then Blackstone again. It feels like we need to be watching. It's kind of counterintuitive, because I came in this morning and I looked at the breakdown in terms of the stock performance on the S&P 500 yesterday, and it was private credit that was at the top. And that was following the news that BCRED, the Blackstone flagship fund, that they had put the redemptions in place around 5%, having seen a tick up in withdrawals. But the detail, according to some of the reporting out there, the detail that came through on the filing from Blackstone suggests that there was some reassurance from investors, that they didn't see as many withdrawal requests in the more recent quarters, that they're starting to see some stabilisation. So that seems to be one of the factors that led, interestingly, to the rally in private credit that you saw yesterday, with the likes of KKR and Ares and Blackstone all putting in very strong performance. Yeah, notably Blackstone-backed Liftoff up 24% after their IPO as well, so one to watch there too. Now, coming up on the programme, Ukraine's president proposes peace talks with Vladimir Putin in a rare open letter, so we'll get you the details on that. Plus, Meta's chief AI officer on whether he thinks the company can keep up with Anthropic. But up next, Cameron Cries from Bloomberg's MLive teams over from the States. We'll get the macro man's thoughts next on the markets. But if you've got any questions of your own for our guests, please do send them to us on IB plus BBTV Go. We'd love to hear from you. Good morning. This is Bloomberg. We are about 45 minutes, a little away from 45 minutes away from the opening trade. Happy Friday, everyone. European futures currently pointing actually to gains of 0.1%, looking to build on the upside of about 0.5% that came through for the European benchmark yesterday. A very different picture when you look at what's happening in Asia, with the MSCI Asia Pacific currently down 1.6%, and US futures as well. S&P E-minis down 0.5%. Oil prices, though, steady this morning, and maybe that's a supportive factor for the European picture. No sign of progress, though, in ceasefire talks between the US and Iran after the worst burst of violence in weeks in recent days. This as the Iranian-backed militant group Hezbollah rejected a US-brokered truce in Lebanon. For more, let's bring in Bloomberg Horizons Middle East and Africa anchor Abir Abu Omar, who joins us from Dubai. Abir, what do we know about Hezbollah's rejection of the ceasefire then, and President Trump's response to that?
Yeah, good morning, Tom. So we've got three sides to the story here, right? The Hezbollah story, President Trump, and the wider response from Iran. Now, the chief of Hezbollah, which is backed by Iran, Naim Qassem, came out and said that the talks that happened between Lebanon and Israel, brokered by Washington earlier this week, are absurd, and the deal reached there was also absurd. He refuses to acknowledge the ceasefire. Hezbollah itself refused to acknowledge these talks and did not take an active part in them. And so the hostilities between Israel and Hezbollah continue within the southern part of Lebanon, but also the northern parts in Israel until yesterday. President Trump, on the other hand, has said that he did not see the rejection from Hezbollah. And as a matter of fact, he's been in touch with representatives who told the president that they wanted to have the ceasefire. And he actually also said that talks with Iran and reaching a deal is in its final stages. Now, on the Iran front, Abbas Araghchi, who is the foreign minister there, said that the progress in talks towards the deal has stalled. We're not seeing any tangible signs of that being reached. So we're seeing, again, these conflicting statements between the three parties, Lebanon now included, as a sticking part for Iran to reach the MOU, that's what we've been calling it, to reopen the Strait of Hormuz and have a ceasefire extended for 60 days. Many conflicting statements. We still await and see heading into the weekend.
And just going back to oil, OPEC Plus meeting this weekend, of course. What should we expect? Of course, the UAE no longer part of the alliance.
Yeah, it's certainly a new chapter for OPEC, especially with the UAE leaving it in a surprise move last month, but also what is happening in the Strait of Hormuz that is still effectively shut. So here is what we expect. Some delegates have been telling us that the alliance wants to bring back supply to the market. That's supply that was cut back in 2023. So that is a positive sign. But the question here really is, Lizzie, and what's different this time around is that, fine, they can supply oil barrels, but can they deliver them because of the shocks that we've been seeing as a result of the closure of the Strait of Hormuz? Now, countries like the United Arab Emirates, like Saudi Arabia, have been diverting the traffic away from the Strait of Hormuz. The UAE, on its own remit, has developed new routes up the coast of Fujairah, that's in the northern part of the country, to get oil barrels through the Gulf of Oman, staying away from Hormuz. That's an extra 1.5 million barrels. Saudi Arabia has kind of stayed away from the shocks by rerouting to the Red Sea. But the question here really is how does the OPEC Plus alliance face this shock and not just produce more barrels, but how can they deliver them to the world?
OK, Bloomberg's Abir Abu Omar with that update. Abir, thank you. And with no clear off-ramp yet, of course, to the conflict in the Middle East in sight, let's bring in a view on how markets are reacting with Cameron Kreis from the Bloomberg M Live team. Cameron, we're seeing a bit of selling pressure when it comes to the AI trade right now, and we're seeing that in the US, and certainly we're seeing it in the Kospi in Asia today. Are we starting to see investors factoring in an environment where physical supplies of oil are going to inevitably push up prices? That's going to have an impact on this AI trade. Do we get to a point where the oil story starts to derail or starts to become at least a headwind for the AI story?
I mean, maybe, but I don't think that's what's driving things. This looks like much more of a sort of a risk management operation or a risk management process that's playing out. I mean, as you alluded to earlier, Kospi is up 100% this year. it makes sense to sweep some of that off the table. And if you look at some of the capital flow data from Korea, foreigners have been selling the market like every day since the beginning of May. And I think yesterday was the second biggest daily outflow of foreign investors from Korea on record. And that's just a natural rebalancing of portfolios. If you were a global equity manager or a global EM manager, maybe you've got caps on your exposure to a single country or a single name. And Korea's rallied so much that you've essentially hit those caps and you're forced to liquidate. It's been the Korean retail investors who've been taking up the slack and helping to push the market forward, but they're arguably sort of less strong hands because they're buying at a more elevated level and are less able to have less wherewithal to weather a 5% drawdown, which seems like a big deal, but think of it this way. The Korean market's up 100%. Divide that by 10%. Yeah. That's a number that we're sort of more familiar with. In that context, a 5% drawdown in the Kospi from a statistical significance perspective is like 0.5% for a market that's only gone up 10%. So when you think of it in those terms, the magnitude or the amplitude of the moves that we're seeing make a lot more sense in the context of the broader volatility.
So this consolidation that we're seeing is healthy?
Well, I think whether it's healthy or not, it depends on whether we kind of do a gamma shape where we go up and sideways for a bit, or more of a lambda where we go up and back down. It's certainly overdue because markets can't rally 100% in a straight line without some sort of pullback.
And is it healthy if it continues in the US? You've got Nasdaq futures down again today. If we actually do start seeing the AI story questioned more, and indeed if the war ends, do we go back to discussing the end of US exceptionalism?
Quite, perhaps. The issue, I think, is that the AI theme has reasserted itself to such a degree. And if you want to play that theme, and you've talked about SpaceX before and the sort of pie-in-the-sky dreams of the revenues coming perhaps 5 years down the line, if you want to play that theme, you've got the U.S., you've got Korea, Taiwan, but you're not coming here. You're not coming to Europe for that sort of exposure, and that's what people want.
Is it pie in the sky, though? You've got Evercore talking about AI revenue 100 times higher, yes, by 2030. Do you see it as just investors going to be buying Elon Musk?
Yeah, I think that's what it is. I looked at this yesterday. I believe their AI revenue was $4 billion. So are they really going to have maybe they have $400 billion of AI revenue in 4 years. Even if they do, and the company doesn't move a dime from the IPO price, they'll still be trading at a higher price-to-sales ratio than the broader S&P is today. So, there's a lot of good news in the price.
What role does Europe have to play then?
As a diversifier, I suppose. Yeah. If you remember last year, we had this theme of European defense spending, and I think that is an alternative secular theme that's going to continue. Nothing that we've seen this year suggests that Europe doesn't need to take care of its own business when it comes to defense. That trade has obviously fallen out of favor because of the oil spike, because of commodity price spike, but that doesn't obviate the need for Europe to make these investments over the span of a few years. Are they less sexy than the AI investments? Absolutely. Are they just as necessary? Also, absolutely. And that is going to feed through into market pricing. We have seen actually these stocks have been beaten up. So you could argue that now is the time that you should be thinking in those terms rather than paying the top and some of the more high-flying stuff.
Cameron, I can't let you go without talking about the jobs data, the Fed, the macro man in town. There's this rumour going around that Kevin Warsh isn't going to publish his dots at Fed meetings. How would markets interpret that? Would they be able to let it go?
Well, he has been skeptical of this Fed, I don't want to say fetish, but it's almost been a fetish of forward guidance and holding the market's hand, telling them exactly what they're going to do, refusing to surprise the market at all. I think you can argue that has artificially depressed risk premia over the last 10 or 15 years. It made sense in the immediate aftermath of the GFC. It's made a lot less sense when we've had the financial performance that we've had over the last 10 or 15 years. The argument in favor of him sort of omitting a dot would be a sort of soft entry into killing the dot plot. Because if the chairman, I should say, isn't submitting one, then its utility is much less, obviously, than if he does, and it would be sort of an entryway. It can plant a question with a friendly journalist or something. Hey, we see you didn't do. It looks like you haven't done a dot. Why not? Well, I'm skeptical of the necessity or the utility of this framework, and that's something we're going to be looking at potentially to get rid of moving forward. It would be a nice entryway, perhaps less shocking than just doing away with it tomorrow or in a couple of weeks.
Has the market shaped which Kevin Warsh is going to turn up?
I think no. I don't think there's not a conviction, because we all know what he would like to do. Even, there was a story the other week about how he wants to focus on trim mean CPI, which just by coincidence is like the lowest possible inflation metric you can get of the panoply of inflation measures. He was on record last year being a big proponent of this idea of AI as disinflationary, positive productivity shock, which would allow for lower interest rates than otherwise would be the case. But obviously the inflation numbers haven't played ball. And as the hyperscalers have ramped up their issuance, I think that the other issue is that clearly the thirst for capital to fund the AI trade has gone up substantially. And what is the neutral interest rate? It's the interest rate that balances savings and investment. Given that the thirst for investment is so huge, the natural conclusion is that the neutral interest rate has risen. You need a higher interest rate so that savings becomes more attractive. And that's something that perhaps Mr. Warsh has yet to come to grips with.
The neutral rate being what, 3?
In terms of the nominal rate, you could argue that it's 4. And we haven't had inflation at target in 5 plus years. So and we've been on a 3 handle for the last whatever it is for the last 6 months. 3 and 5/8. I ain't cutting it.
Cameron, thank you very much indeed. Fantastic to get you on set this Friday. Cameron Kreis from Bloomberg M Live, of course. Read all of his commentary there on the terminal, of course.
Well, here's what else you need to know this morning. Stocks in Indonesia have tumbled, and its currency is at an all-time low as global investors rapidly lose confidence. The Jakarta Stock Index has fallen more than 30% this year to a 5-year low. Investors have been unnerved by the more populist and interventionist agenda being pursued by President Prabowo, including taking direct control of commodity exports. Elsewhere, Ukraine's President Volodymyr Zelenskyy has proposed peace talks with Vladimir Putin in a rare open letter, saying that Ukraine is ready for a full ceasefire during negotiations. Putin has pushed back against separate efforts by European leaders to help negotiate an end to the war, saying that they cannot be mediators when actively supporting Ukraine. And the Mayor of Manchester, Greater Manchester, Andy Burnham, has confirmed for the first time that he intends to challenge Keir Starmer to be UK Prime Minister if he's elected as an MP. Burnham is standing in a special election near Manchester later this month. Starmer immediately hit back, saying he would not walk away from his mandate. Well, this is interesting, Tom. So, he's already talking about the leadership race, but if Burnham can't get past this by-election, the best man, it seems from the polling, for Labour, can Labour win the general? If he can't beat Reform in the by-election, can he beat them in the general?
What are the polls suggesting, Makerfield? It's quite finely close,
Very.
finely run, isn't it, between Reform and Labour? And so there are real questions about what happens if Burnham, who's now been explicit in his intention to challenge the Prime Minister, what happens if he doesn't win that constituency?
We all knew, but he said it out loud. It's going to be Burnham versus Starmer and some others.
Coming up, the M Live Money and Macro event was here in London last night. We're going to be joined for a roundtable with 2 of the panellists, Schonfeld's Colin Lancaster and Schroders' Remi Olu-Pitan. That is next. This is Bloomberg. Happy Friday. 30 minutes from the start of the opening trade. European futures are currently flat. So far, outperforming at least their US counterparts, at least today. New in the US, S&P E-mini is pointing lower by 0.6%. Nasdaq 100 futures pointing lower by 1.1%. We had a bit of a sell-off, of course, in tech yesterday, semiconductors, but some resilience in terms of the banking space, in terms of some of the industrial names, and interestingly, private credit as well, performing quite strongly in the US session. But again, European futures flat. FTSE 100 futures looking to add 16 points. CAC current futures currently looking to add just 6 points.
In your bond space, yields lower across the European curve as things open up, only by a touch, it has to be said. So tracking Treasury yields lower. On the 10-year Treasury, we're down a basis point at 4.46, and you can see the German 10-year yield there at 3.02. So really not much doing, but we're waiting for that US jobs report later on today.
Now, here in London, last night I moderated the Money and Macro event with Bloomberg MLive, the team there, of course. Two of our panellists are joining us now on the show today. Very pleased to say, Colin Lancaster, Global Co-Head of Discretionary Macro and Fixed Income at Schonfeld, and Remi Olu-Pitan, Head of Multi-Asset Growth and Income at Schroders, are with us on a day when we can seeing volatility, at least in the Asian tech space. Kospi is in focus for us. Again, Nasdaq 100 futures, as I mentioned, cooled lower by a little over 1%. Remi, I'm going to start with you because there was a comment you made last night at our event that really stuck with me as I woke up this morning and checked the price action in Asia. You said, I think I'm paraphrasing, but you said the Kospi is too risky. At least it makes you sweat. And today, I think and I suspect that the Kospi is making a few investors sweat.
Absolutely. I mean, the key issue right now that we're facing with the Kospi is the amount of leverage that's associated with this rally. So the correction today is associated with some of the leverage ETFs where a lot of retail investors have piled into. Now, what that means is that equity markets will rise very quickly, but the falls will be just as large. So you've got to go in knowing that.
Colin, I was going to say, I'll get you to weigh in, but for some, this will be a buying opportunity.
I think there's an interesting dynamic at play related to leverage. I think that, being on the macro fixed income side of things, we're accustomed to hearing about balance sheet constraints more in terms of repo funding and on the fixed income side of the equation. And I think what's happening because of the concentration and the amount of leverage and levered expressions, but also just the size of the notionals now, with Kospi up 100% this year, is the leverage needs to maintain these positions are somewhat finite, and the street needs to find a way to continue to finance some of this activity. So I agree. I think what you're seeing overnight is a bit of a risk management exercise as a result of that, and some prudent, profit taking.
And then when we think about tech more broadly and just the rally in stocks this year, Remi, I do wonder where you think the S&P is going to be ending the year and really how much that SpaceX IPO is going to give some fuel to this market.
We're thinking of the IPOs as giving the market maybe a little bit more room to breathe, because this provides liquidity and the market needs to absorb a lot of supply. So perhaps that might lead to a bit of a healthy pullback. Maybe the word healthy might need to be stretched in terms of the magnitude of that pullback, but we're still very constructive. If anything, any pullback right now is an opportunity to invest.
And what level on yields then, or pace of rise, derails the rally?
Yeah, look, I think another bout of a taper tantrum would certainly do that, and it's my personal belief that you will see terminal levels continue to rise because of the strength of the economy, the inflationary pressures overall. On that point in terms of just bond yields, and look, today is a payrolls day, so happy payrolls day. I do think that in some ways the importance of that number today will be overshadowed by the new chair's Warsh's first meeting in 2 weeks' time, where I think market anticipations will be centered around what he does in terms of forward guidance, size of balance sheet, some of his early agenda items and how he begins to shape the Fed.
Yeah, we were just talking about if he scrapped the dot plot. What if he scrapped press conferences?
No, I think that that's a possibility of, what he stands for on the tin is a smaller balance sheet, which I think will be a very difficult issue. Lori Logan owns that agenda item at the Fed right now. She's very well respected. I think that Mr. Warsh is a high IQ, savvy political operator, will understand that he needs to tread lightly on that issue. But on the forward guidance side, that is one where he can have more of an impact. Look, prior to Chairman Powell, press conferences only happened quarterly or even less frequently. So certainly you could see forward guidance by virtue of press conferences, by dot plots, by SEPs being changed now, which, look, I think that would add to vol in front-end rates markets. But I think that is an area where you could see influence.
Remi, when do higher yields become a problem for the equity market?
At the moment, the equity market can absorb it because we have growth. So we're looking at things in terms of nominal growth. But if we start moving towards 5% and above, that is a challenge for these levels of valuations in the US or DM.
How convinced are you that the growth story in the US remains sustainable and that the AI capex spend is a significant part of that through 2027?
We think that it's sustainable for at least another 12 months to 2 years. I mean, the reality is that financial markets move at a very different pace to the economy. So it will take a very long time for the productivity gains to emerge in the real world. Nevertheless, what we are seeing in the US is a very surprisingly stable economy, despite all the external issues that have been thrown. And we think that that will continue.
What about the UK? Because, Remi, I was curious to note that you like UK equities. Is that just a war trade? Will you drop it as soon as there's peace in the Middle East?
We like it because it's something else other than AI tech, and we're not as well. Certainly, the FTSE is not as exposed to the negativity of the Middle East tensions around high oil prices. If anything, the FTSE 100 benefits from higher energy prices. So, FTSE right now gives us something different. Think of it as a barbell strategy. Own the tech theme, because there's definitely more to go, and try and find something that's a little bit more diversifying.
So that's the equity side. Colin, you look sceptical.
In terms of the fixed income markets, gilts are the new widowmaker for, people in seats like mine. And look, I having traded through Brexit night, I think Makerfield gives me some PTSD of Sunderland and some of the early voting results. So, yeah, I think it's a much more complicated issue in rates.
Well, because we saw yields go up on the politics and then down on the economics. Do you think that we're just waiting for a massive yield spike if Burnham wins that election?
Yeah,
right, okay.
When would you step into gilts? I mean, we're on the 10-year right now, 4.89. We're close to 5% on the 10-year. What level brings you? Is it 5.5? Is it 6?
Yeah, I think there's a temptation. There will always be buyers stepping in at that 5.5 level to put a benchmark out there. But look, I think that there is some scar tissue that's developed. Following the March episode, where it was the front end of the UK markets, which kind of really led the pain across macro fixed income. So I think that there will be more skepticism, and there's probably less buying power at the moment in terms of just market participants not having the embedded, built-up P&L to be able to take more risk in markets like that.
How are you looking at the sovereign debt of places like France? I mean, they've got elections as well coming up. We had a guest on a couple of days ago saying they're staying well clear of OATs. They're starting to cut back on any exposure to OATs on concerns about political risk in France.
I think it's an important issue because over the last 10 years, I think, with the benefit of hindsight, it was a very benign period because there were a lot of more price-insensitive buyers of duration, meaning central banks, meaning liability-driven pensions, meaning Japanese financial institutions. And for a variety of reasons, those buyers are seemingly withdrawing. At the same time, there's more competition for that funding capacity, whether that's hyperscaler issuance, which is also not as level dependent, and just Bloomberg put a great piece out yesterday on mortgage hedging. Mortgage hedging is back now, also competing in that space.
Remi, the other call of yours that stood out to me was that you like gold, even though central banks are expected to hike. Is it that you don't think that the hikes are coming?
So it's been tricky for gold over the last couple of weeks, admittedly. But really, the view for gold is related to that, in that we no longer have price-insensitive buyers of bonds, which is making bonds very volatile. So what is the next asset to own? We think gold is maybe a lower quality alternative. And the reason why I'm using lower quality is that it's not a hedge in any form. But what gold provides is an alternative asset to own when you're thinking about currency debasement, when you're thinking about volatility, when you're thinking about the fact that we're moving away from a Fed that may not provide forward guidance. We're in a new regime, and so it's important to own something else.
Remi, if we come in on Monday morning and there is a deal between Iran and the US that involves the reopening of the Strait of Hormuz over some time frame, how would you position around that?
Oh, we think that that will be a great opportunity for Europe, even though over the long term we're not in love with European equities. But Europe has lagged, and I think a lot of that is due to the concerns around the Straits of Hormuz and what that means for energy prices, particularly gas prices in Europe. And so if we hear that on Monday morning, I think, yes, the Euro stocks will rally hard.
Look, if you were to have a bona fide long-term deal that is clearly a vol dampener, risk rips, crude gets, is down big, like that is a, significant easing of financial conditions. I would say, I think on our side of the table, we remain skeptical of that. We think that probably what is best to expect is more of the skinny deal, which is a bit of a glorified ceasefire. So I think it's hard to imagine that does come into play.
The skinny deal, the muddy deal. Yeah. We look for a deal. Yeah. Colin, thank you very much indeed. Colin Lancaster, Global Head, Co-Head of Discretionary Macro and Fixed Income and Head of EMEA at Schonfeld, and Remi, Olu-Pitan, Head of Multi-Asset Growth and Income at Schroders. And if you missed last night's money and macro event, terminal users can still access highlights using the function M Live Go on the terminal. So we've been discussing this. The US set for 3 blockbuster IPOs this year. What's driving this trend? Daniela Amodei, the president of Anthropic, has an idea.
It's a really big kind of upfront cost to train the models and to serve inference on them. And I think that is, my guess is that, over time, the sort of core set of companies that are working to advance the frontier are just going to need access to capital. And I think the public market is very well suited to that.
Okay, the co-founder of Anthropic. We're going to have more on the SpaceX IPO with 7 days until liftoff. That's next. This is Bloomberg.
What I think is interesting about the IPOs is that they're being designed in some ways to encourage retail participation, with higher allocations and with, relatively small free floats compared to enormous market cap.
I do think some of these business models are going to struggle. I think the hard part for investors is to figure out which one is actually going to thrive.
A lot of the incremental improvement in profit of the big, mega cap techs is the increase in share value of their investments in these other, in just like, Amazon's profits get boosted by the fact that its Anthropic share, goes up X percent. And that means that when there's a problem, this is just going to be so bad.
The way we think about it is probably technical in the nature, rather than changing fundamentally what is happening in the market. We don't think that it creates instability. We actually think that there is enough capacity in the market to absorb that.
There probably is enough capital out there to fund it, but I think we're certainly going to have a negotiation period on how much people are actually willing to pay for those.
SpaceX has put projected valuations up at such a level, everybody else has to come up to try. They're getting a boost. Because
this is ironically a gravitational effect for a space. Yeah,
exactly. Investors are going to say, "Show me the money." Okay, I put money into you at these exorbitant forward valuations. I now want to see something on the table in terms of your revenues and your profits.
There's still plenty of cash sloshing about in the system, and a lot of cash looking for a home. The big question is whether or not that cash is willing to pay the valuations being asked. The order is very important when it comes to these giant IPOs. You want to be first because that's the one where there's going to be the most demand.
All right, a few of the guests then we've spoken to throughout this week giving their take on the blockbuster IPOs heading to the market. Sticking with that theme, S&P Dow Jones indices rejecting proposals for a, quote, fast entry path to its main benchmarks for newly public mega-cap companies like SpaceX. The index provider says it will not shorten the 12-month waiting period for new public companies, unlike its rivals Nasdaq and FTSE Russell. For more, let's bring in Matt Bloxham, analyst at Bloomberg Intelligence. Matt, why has the S&P decided to draw the line on this issue?
Yeah, I mean, I guess they're just trying to kind of preserve the sanctity, if you like, of what their indexes are trying to do, which is kind of, reduce volatility and more passively track what's going on in the market. And I think, and avoid being too faddy, if you like, about where these indexes trade. So, I mean, it's interesting now that we have a kind of polarization between, kind of these big index providers and S&P clearly kind of setting out a very different stall. So, I think maybe to some degree, investors looking for an ETF that's got a bit more volatility and growth exposure might kind of shift towards some of the Nasdaq or Russell indices. Somebody that's perhaps looking for a kind of more risk-averse may kind of be gravitating more towards S&P, so it does kind of create some differentiation in the market.
Matt, what do you make of the estimates that SpaceX's AI division could see 100 times revenue growth by the end of the decade? You don't have skin in this game, so I feel like you could play the ref on these.
So the numbers are quite staggering. So, if you look at some of these estimates, Goldman's and Evercore, the ones that we've kind of, seen as great Bloomberg News article about it, getting on for kind of $300 to $400 billion of revenue from that division by 2030, so 4 years from now. Now, I did a little search on Ask Be Our AI assistant about what the top 20 companies are in the world by sales. There are only two with more than $500 billion of annual revenue, and that's Amazon and Walmart. The next ones are in the kind of $400 billion range. So, that kind of shows you the kind of unprecedented scale of growth and just scale of the company that people are expecting this to kind of turn into in such a short space of time. And I kind of go back to the kind of basics of how you run a business. To generate revenue, you have to invest in assets, and this company needs to invest in data centers and software and technology. And you have to wonder, can they physically create enough assets to generate that kind of revenue on a 4 to 5 year view? And I think that's a big question.
Matt, should we take a listen to Elon Musk himself talking about data centers? I think we have a soundbite. Let's play that.
It's really just solar power plus radiator, some basic equipment for operating the satellite, and then the laser links, which would connect to the Starlink communications constellation, and then back and then to the ground. And the connection would happen no matter what the weather is.
Okay, so there's some of the explanation around how all the different assets that SpaceX has will connect together to provide this impulse and the connectivity and the AI services that they think they're going to be providing into the enterprise. And that is a huge piece of it, is the AI provision into enterprise in terms of their expectations around revenues. And that will sit on the data centers in space.
Exactly, yeah. And he makes it sound ever so simple to put these things in space. And it's true that all of the components to go into an orbital data center exist and they work. There's, I think, for me, a couple of big challenges. One, just physically miniaturizing that to a degree that you can launch enough of it quickly enough, because these things are going to be big and super heavy, and then you need the rocket platform to actually deliver that stuff in space, because you only shrink it so much. And so Starship needs to go from being a kind of still a somewhat clunky test project into something that's massively scaled, so that there are a lot of hurdles. I think probably some of the more complex engineering things have been solved, but you still need to make it light enough and small enough to make it something you can actually scale into a 100 gigawatt orbital data center that can generate this kind of revenue.
Matt, thanks for the analysis. I'm sure we'll have you back many times before the actual IPO. Matt Bloxham there, analyst at Bloomberg Intelligence. Let's get over to our stocks to watch now. Chloe Melly has those for us. Chloe.
Good morning, Lizzie. Let's start here in the UK because Greater Manchester Mayor Andy Burnham has confirmed for the first time that he does indeed want Keir Starmer's job. And so we should be watching out for any impact there because some investors have been worried about what Burnham in Downing Street would mean for things like fiscal policy, given that he sits more to the left of Keir Starmer, although Burnham has been trying to reassure the market in that regard. And so we should be watching out for those sectors that tend to move when there's a bit of political turmoil and instability here in the UK, so banks and retailers in particular. Moving on to Inditex, which was in the news earlier this week with strong earnings, and today we've got an upgrade from Morgan Stanley with the analyst saying that it was standing out in a tough consumer sector thanks to a strong positioning and accelerated investments, and so that could boost the shares even further. This morning we've seen the earnings lift the stock, and we could see that continuing today. And finally, let's end with some M&A because the struggling gambling firm Evoke here in the UK has agreed a deal with Borley's Intralaw that values Evoke at £243 million. It's a company that had been struggling for some time because it's facing quite a high debt burden and also higher gambling taxes in the UK that came into effect in April. And so we could see perhaps this deal lift the shares this morning. It has been exploring a sell since late last year, and now it's finally happening for Evoke.
Okay, Chloe, Melly, thank you very much. There are some others that we could throw into the mix here, Tom. So we've got an eye on European sportswear stocks. Lululemon cutting their sales goal. I do wonder how much that'll translate, though, because Lululemon kind of struggling to stay cool at the moment. So is it going to feed into the likes of Puma and Adidas?
They've had some issues, haven't they, over at Lululemon? So we'll see what the read across is. Raspberry Pi, interestingly. I'm going to be watching that stock, of course. They make these computers that you can self-programming. There are some calls that this may move higher. They come through with adjusted earnings, and they're confident of meeting their full year 2026 goals. So it's a hardware play. Actually listed here in the UK around the tech space, so that will be interesting as well.
But of course, more broadly, we've got to keep an eye on tech. This mood in the markets more broadly being set off with the Broadcom outlook and then carrying on in the Kospi. The Kospi actually paring some of its earlier losses through the session.
Is Europe where you find some safety in this environment? European futures pointing higher by 0.1%. It is the opening trade coming up. This is Bloomberg. A few minutes to go then until the opening trade. Here's what happened yesterday. We'll just reflect on this because European stocks across the benchmark put in gains, and this is where Europe closed and the S&P 500 continued and actually ground out some upside of around 0.4%. There was some divergence, though, interestingly, by the close of play. The Nasdaq 100 ended lower. The S&P 500 ended up 0.4%. There was money moving into the Dow Jones, and you saw some of the industrial players. You saw the likes of Boeing and Caterpillar getting some upside, along with the banking space as well, and the asset managers, the likes of KKR, the likes of Blue Owl, the likes of Blackstone, actually putting in strong performances despite the continued focus on what's happening around private credit. So there was some divergence in terms of what happened and some rotation under the hood when it comes to the stock story. Today there's a focus on what's happening in Asia, certainly the sell-off there in the Kospi. Broadcom, of course, putting pressure on the Nasdaq 100 yesterday, and there's a Broadcom story that seems to be filtering over in terms of the caution over in Asia today. European futures, though, maybe this is a little bit of a haven. Maybe there's a little bit more resilience in European stocks if we have this angst around AI, maybe AI running too fast and too far. Up 0.1%, called higher by 0.1%. FTSE 100 futures looking to add 41 points. DAX futures, though, pointing lower by around 0.2%. What are you looking at, Lizzie?
Well, of course, we'll watch what tech there is here in Europe, Tom, but in terms of specific stocks we're watching, UK stocks in focus now that Andy Burnham said publicly he wants Keir Starmer's job. We'll look at the banks and retail in particular. Then, speaking of retail, Inditex, the Zara owner, of course, upgraded by Morgan Stanley, so we'll watch them closely. And European sportswear stocks as well. Lululemon cutting its sales goal. These could be active. Net revenue guidance at Lululemon for the full year cut. So they're what I'm watching, Tom, as we inch towards the open.
Yes, a big macro event, of course, later today will be non-farm payrolls, 1:30 p.m. UK time, and of course we'll be across that for you with the markets finally balanced in terms of whether or not the Fed goes with a hike this year. FTSE 100 then putting in the first couple of points so far on this Friday session, just marginally higher as we get the pricing coming through. We've got to think about the sector breakdown as well. It was healthcare that actually outperformed yesterday. Some real strength in the healthcare sector in the European space. Across the benchmark then, Stock 600 modestly in positive territory. And again, maybe this is a bit of sentiment around wanting to see what the next catalyst will be. There is still the standoff that happens around the Strait of Hormuz. No real clarity on that front. FTSE 100 now up 0.1%. The CAC growing over in France, putting in gains of 0.2%. The IBEX is also performing relatively well so far in the opening first few seconds, up 0.4%. We wait for the pricing on the DAX, which had been called low. The FTSE 100 is now flat. Lizzie, what are you seeing across the sectors so far?
We've got about three-quarters of sectors in positive territory so far this morning, Tom. So utilities at the top of the basket, leading the gains, up nearly 1%. Retail not far behind, consumer products and services and construction as well. But bottom of the basket, as we have seen around the world, is tech, down 1.1%. It's the story that you flagged on the Kospi. We've seen it indicated for the Nasdaq, lower there as well. But of course, we have limited exposure here in Europe to tech, so hence the broader, less negative picture, shall we say, for European stocks this morning. The Stock 600, as you say, only flat to the downside. In terms of some of the individual stocks that I had flagged before the open, Inditex shares, as expected, higher 0.8% after that upgrade from Morgan Stanley. And we had been looking at European sportswear stocks after Lululemon cut its sales goal. Actually, Puma shares up 0.6%, so perhaps a little schadenfreude there.
OK, shall we get to our next guest and get some analysis across these markets then? Standing by for us is Christian Mueller-Glissman, Head of Asset Allocation Research at Goldman Sachs. Christian, good morning. Should we start with the here and now then? Pressure over in Asia, a little bit of selling pressure coming through on the Kospi in the context, of course, of gains year to date of around 100%. Is this a healthy consolidation that we're seeing when we look at the Nasdaq 100, when we look at the Kospi, or does it point to a more kind of foundational and structural shift in sentiment?
I mean, it's been a remarkable rally. It's been pushing these momentum stocks up a lot. There's a lot of speculative positioning that has built up, leveraged ETFs, all kinds of options positioning. So I think you could say it is healthy that you get a bit of a step back. I think the rally was very much driven by earnings, which was unusual. You remember, you have 320% earnings growth on the Kospi this year. So it was already fundamentally more healthy than a lot of these momentum rallies that we've known before. Less valuations, more earnings. But I would say, considering what we see on some of the positioning data, it's probably not a bad idea to see a bit of a consolidation, to kind of see if there is some leverage buildups that get flushed out. And I think fundamentally, obviously, we had the Broadcom results, which made people kind of rethink in general, kind of how you want to extrapolate those earnings, because it's a very cyclical industry. Like tech hardware and semiconductors, 320% earnings growth for Kospi. You need to be very careful what you extrapolate from that. So it's quite healthy to rethink.
You're very clear that semiconductors remain cyclical.
I think, listen, it's a good question because you have a multi-year trend here in AI capex, and you could say, look at Nvidia, how it started and how it's still going. So you could say that's also a cyclical company theoretically linked to tech hardware, but it's been doing really well for multiple years now. So if you think the AI capex boom is a structural thing that lasts for multiple years, maybe it's a bit less cyclical in the near term, but it's still a very high operational leverage kind of cyclical industry normally.
What if the Iran war ends? Does that knock AI leadership and the S&P and then bring investors back to EM and Europe as well?
I think so. I think there's definitely a divergence currently between growth optimism, especially in the US, which is boosted by AI capex, which is boosted by a reasonably resilient US manufacturing sector. You saw the ISM manufacturing, so it does feel like the growth optimism has been very strong, but rates relief has not been happening. So if you get now the reopening, you probably get rates relief, which can drive a bit of a broadening out. I mean, think about the divergence between momentum stocks and low volatility as a style, which are these bond proxies, low volatility stocks. They have literally done the worst you've seen in a long time. So they're obviously linked to rates. and they're not exposed to tech. So they're in the worst spot. They had kind of the upward pressure from rates, and they had no tech. So if you get a bit of broadening out, a bit of rates relief, you could get a bit of a snapback there. So I would say the reopening of this trade could definitely help create a bit more broadening, a bit more kind of healthy kind of rally.
And if we get a strong payrolls today, another one report, is that good for equities, bad for rates, basically?
Well, this is a really good question. To some extent, I mentioned earlier that the US has been strong on the data. It's looked a bit reflationary, you could say. Good nominal growth, kind of a lot of lead indicators ticking up. Earnings growth is strong. A bit more inflation as well, but actually core inflation has remained reasonably anchored. So it looks kind of like a friendly reflation. So if you now have a payroll sprint that's strong, like it really creates a difficult spot for the Fed to keep talking about symmetric kind of monetary policy, because there's a good chance that they need to start talking down the cuts, starting to talk more about hikes. And that could actually mean that you get rates pressure, which kind of feeds back into equities. So I feel like not too hot, not too cold is the best. We are slightly below consensus, so we are slightly more on the dovish side. But I would still argue that there's a real risk that the market will completely give up on any Fed cuts if it's too strong.
Friendly reflation. I like that framing of what we're seeing in the US. You mentioned the rates pressure, potential rates pressure on the stock story. What kind of levels becomes a problem in terms of price down, yields up?
Yeah. So we usually look at three things: level, speed, and source of bond yield increases. So levels we found historically are difficult for equities to digest is around 5%. It's a bit rough, but we found historically this is when equities struggle. Why is that the case? Like the real trend growth of the US economy is probably around 2.5, plus 2.5 inflation in the long run. You're at 5. So if you're above that, you might get worried that rates are too restrictive in the back end. And I think then it's about the speed. What we found is if over a 3-month horizon, the speed is more than 2 standard deviations up, you get into trouble. This was the case. You're at 1.9 on May 19th, when equities had a bit of indigestion. You're currently at 1.1, 1.2. So like you're still, the speed is not a problem currently. And then it comes down to source. If it's because of inflation, usually the market doesn't like it. So it's not just the level, but I think if we do actually get it because of inflation, it's problematic. If it's because of a stronger labor market, it's not so bad, because we actually still have a lot of investors that are worried about the consumer in the US. So if you do get continued signs that the labor market is strong, it could actually be okay for equities, but it will create upward pressure on of course, the bond market.
Do you think that is the most likely factor at this point? Is less likely to be inflation? You were talking about the fact that core inflation is relatively stable, and yet the strength seems to be coming through for the labour market, and the broader macroeconomic picture is looking resilient in the US. So is that what gets us to higher yield? Do we and is that where you're leaning at this point? And does that take us to 5% by the end of the year on the 10-year?
We're not at 5% in our target. I think if you get into a reflation in the US, where manufacturing continues to be strong, the labor market strengthens, AI capex continues to be resilient, boosting the S&P, which in turn is easing financial conditions. So the whole system on itself actually continues to do really well. I think the upward pressure on longer dated yields will continue. There's an unfriendly narrative that could also create upward pressure, which is linked to core inflation actually picking up. Because we know when the Strait of Hormuz doesn't reopen by the summer, it starts to feed into fertilizer prices, which is kind of impacting the kind of farmers planting in October. Then you know that food inflation might actually be higher next year. Then you know actually that usually feeds into wage inflation with a strong labor market. So before you know it, you get to a less friendly inflation narrative if the Strait doesn't reopen.
We're getting close to that point, it seems.
Yeah. I mean, big picture, Christian, what's the bigger risk to equities? Is it earnings disappointing or a bond sell-off?
It's a good question. I think I would say it's more earnings disappointing. I mean, you always got to ask yourself what drove the market really higher. And it's been earnings revisions, earnings momentum. You've seen like earnings in Asia being upgraded 50, 60%. You've seen earnings in the S&P being upgraded 20%. Even in Europe, earnings got upgraded 10%, helped by energy. So I think my thinking is that you had an earnings-driven rally up. So the biggest threat is the market doubting those earnings. And I think you have to consider that some of these drivers of earnings, as I said earlier, they're a bit cyclical. So you're shifting above trend. So you always need to worry eventually for those earnings to normalize. To your earlier question, is semiconductors a cyclical industry? Yes, I would say so, maybe less with that AI capex spend, but that doesn't mean that there can be more competition between them. That can be another, you might have a strong demand environment, but suddenly you get competition weighing on pricing power, which obviously has boosted earnings. So there are multiple ways that the kind of tech hardware names could actually start to disappoint a bit more.
How clear is your conviction around European stocks if we get a reopening of the Strait?
Listen, it's fantastic because Europe has been the biggest, to some extent, loser from the Middle East war. So I would assume that you get a decent amount of relief. I think the rates relief will be the most important because the ECB is one of the few central banks where you're very clearly going towards hikes. And if you take those off the table and or open the door for cuts, because the market has not only priced hikes for the ECB, they've been very reluctant to price the cuts. Normally, when the ECB hikes, 9 months later, they tend to start cutting. Whereas now, if you look at the ECB rates curve, it essentially prices those hikes. Then, it takes a long time until you get the cuts. Even next year. So if you get more clarity on the reopening and some of those pressures on energy and pricing come down, I think it would really help the market fade those ECB hikes.
Yeah. You just wonder if even if the war ended over the weekend, the ECB would be able to stop that hike in June. Now it's so expected.
Next week, isn't it, the ECB? Yeah. There we go. Christian, thank you very much indeed. Fantastic to get your views. Wrapping up the week for us, Christian Mueller-Glissman, Head of Asset Allocation, of course, Research at Goldman Sachs. Let's check in on the core 6 right now as we factor in some of these issues. Schneider Electric, of course, has benefited from its exposure to the data centre story, is down 1.5%. ASML is taking a big hit, down 3%. That's a pretty sizable move for that company, of course, with its exposure to some of the chip story with the lithography machines going in, of course, into those foundries. Nestle is currently up 0.3%, and you're seeing some very decent upside for Novo Nordisk in the healthcare space. And again, healthcare was the sector that outperformed yesterday across the European space. LVMH and Luxury up 0.6%. Let's check in on some of the other individual stocks on the move. Chloe Melly standing by. Chloe.
Good morning, Tom. We've got the gambling firm Evoke, which is, as expected, reacting very positively to agreeing to a takeover by Bally's Intralot, which values it at £243 million. This is quite a struggling firm that had been really burdened by heavy debt since its William Hill acquisition, and also has been facing those higher gambling taxes here in the UK. And so it had been exploring a sell for some time now, started the process late last year. Now it is finally happening for Evoke, and we are seeing the shares react very strongly to that, and we're up about 12.5% for Evoke this morning. Moving on to the tech stocks, and yesterday we already had some weakness on the back of this Broadcom outlook, and today we are seeing this weakness continue, and we're seeing the likes of ASML, BE Semi down this morning, all in the red, as this enthusiasm for the AI trade continues to wane. Moving on to CMC, which is an online trading platform here in the UK, and it has been upgraded to a buy rating at Jefferies, with analysts saying that it's a company that will have a very good 2027, and so we're up almost 8% on the back of that. Staying in the UK, and we've got Raspberry Pi, which makes computers, and it also up this morning very strongly, about 11%, after saying that it sees earnings way ahead, significantly ahead of expectations. And finally, let's end over in the chemical sector, because Wacker Chemi has been downgraded, cut to a sell rating at Citi, with analysts saying that the momentum for that company is weakening, especially in the upstream chemicals sector, and that they prefer other names in that sector like Novonesis, for example. And so we are down about 3.8% for that company this morning.
Chloe, thank you very much indeed. Chloe Mellet with some of the stocks on the move this Friday. Coming up, South Korea's Kospi, the world's best performing gauge this year, and a bellwether for AI investments, stumbles. We have more next. This is Bloomberg. welcome back to the opening trade. We are 17 minutes into the Friday session. European stocks are actually down 0.2%. Futures had been pointing to a little bit more resilience, but tech is a big drag. The biggest loser across your sectors now. Tech is down a full 2% across European stocks. So that feed across from what we've seen in Asia and the selling pressure there, and the Nasdaq 100, of course, as well. US futures also still in negative territory. So that is across the benchmark here in Europe. The DAX over in Germany down 0.4%. The CAC current is currently flat. That is the story in Korea then. The Kospi taking a sizable hit today, stumbling then. Foreigners pulling more than $10 billion from the market this week. The recent strain then has some traders wondering if this might be a sign of stalling momentum in the global AI tech rally. I think there is some evidence that it is stalling momentum. The question is whether it will be sustained or not. Bloomberg Markets reporter Anthony Stevens has been looking at the details of this. Anthony, explain to us what is driving this sell-off, and whether or not you think this is going to be sustained, or if the dip buyers come back in.
You know, your previous guest touched on a lot of the dynamics towards the back end of his talk with you guys. The market is broadening out, and that isn't great for tech. So as the economic gains and the inflation narrative kind of pick up, you're seeing gains in banks and pharmaceuticals, and you're seeing that in your session today. That's at the expense of tech. Now, in the US and Europe, that net flattens out a little bit. But the guidance from Broadcom was like the first warning that the most exuberant expectations from tech are unlikely to be met. Now, if you watch back the Broadcom CEO's comments on the Bloomberg Tech Forum, he doesn't sound bearish at all. He's talking about insatiable demand and other things like that. But he's also cognizant there is a capacity constraint to how much money people can make before they need to build out new plants and new facilities. And that's caught the market a little bit in a kind of a retracement of some of the craziness. And people are really repricing how much money can actually be made in the next couple of years versus these estimates. Now, your guest touched on the fact that it's an earnings bubble as well. How repeatable are the earnings in tech is now being called into question over the last couple of days. To touch on Korea, Korea doesn't have a financial sector of the size of the US or Europe to cushion some of this outflow. So it's being felt in the tech sector specifically.
And what are the wider impacts on other markets, Anthony, that you are seeing right now as a result of this?
Right, so Asia in particular is getting jolted by this, right? At the beginning of our session, it was a little bit more balanced. Tech was really down and financials were doing fine. As the day went on, though, the fact that Asian retail is so long tech became our Achilles heel. China's tech is down around 3%, Korea tech is down 8 to 9%, Taiwan followed, and Japan is weak as well. So Asian retail is very, very long tech, and now also faces the prospect of a strong non-farm payrolls number tonight, hurting FX in Asia. So Asian investors are under a lot of pressure. As we go to the rest of the world, I think for Europe, people are very long the two big stocks in Europe, but Europe is much, much more diversified than Asia and should be able to navigate this little bout of risk aversion. The US will be a very closely watched session. The Nasdaq futures are quite low on the session today. What is very interesting about the Nasdaq and S&P is this debate around the IPOs that are coming and how much liquidity needs to leave the hotly rallying stocks of the moment to buy these IPOs down the line.
And Anthony, of course, Korea was hotly anticipating Jensen Huang's arrival in Seoul. I just want to take a listen to what he had to say to reporters about demand for memory chips.
We are going to use a lot of high-speed memory. And, of course, memory is constrained, and so we have to be smart about using it in all of our systems. And so we'll continue to work with our partners here to make sure that we support as much supply as possible, but use the supply as smartly as possible.
Anything else that he said, Anthony, going to be exciting for markets this morning?
Well, notable lack of a leather jacket, that's one thing. The second thing is, though, the memory comments are really well flagged, right? You've had Hynix and Samsung go up so much that a lot of the foreign selling in Korea is actually people bringing down their allocation of Samsung and Hynix to more manageable levels. So that story, and Micron is up triple digits on the year as well. So the memory side of things are really well understood. He is also meeting other Korean corporate leaders in the physical AI space, the robotics space, and the software space. So he's meeting Hyundai, he's meeting SK, he's meeting LG, and he's meeting Naver. Now, those conversations and the kind of bullish commentary that he put up in Computex in Taiwan, that is what people are going to be watching in the coming weeks. But for today, that hasn't been good enough. His comments came out in the back end of the Korean session, and the Kospi still closed on the lows. So it looks like Korean retail really needs to see more to reload at these levels.
Yeah, no juice from Jensen at this point. Maybe the lack of the leather jacket is something of a tell as well. Anthony, fantastic. Thank you very much indeed. Anthony Stevens walking through some of the market moves and implications for us this morning. Sticking with AI, Bloomberg held its annual tech summit in San Francisco this week. What a fantastic lineup out of SF. Meta's chief AI officer, Alexander Wang, spoke with Bloomberg's Kurt Wagner at the event. He discussed the progress the lab has made since he started in the role and where he sees the tech firm's models going from here.
The AI industry has gotten very hot and competitive, obviously, in the past year as well, and we take that very seriously, but we're really excited.
Yeah, obviously the goal, you're spending in the same way that an OpenAI, Anthropic, others are spending. Do you feel like you guys are in that same tier? Is Meta, is it OpenAI, Anthropic, Meta at this point, or do you feel like there's still a bit of a gap? Because I'd say certainly a year ago that was the perception.
Yeah, the Muse Spark model that we released is not at the tier of the leading frontier models, but we believe it's a very exciting data point on the trajectory, and we expect the upcoming models we release to be quite competitive with the leading models in the world.
Yeah, you called Muse Spark an appetizer model. To build that metaphor out, when does the entree model get here? Will it be at that tier that you guys ultimately want to be at?
Yeah, we are in process of cooking the.
The whole conversation is just going to be this back and forth.
Yeah, no. I mean, we're cooking it. We're excited to show it to the world once it's ready. We're seeing very exciting and promising results in the process of training it right now. So we're quite excited about it, and I think there's overall we built the entire research effort around predictable scaling. So the entire belief of our overall research effort was, that in many ways the central belief behind the current modern AI boom is that as you scale these models, you will see get incredible results and get predictable levels of increased capability. And so, Muse Spark, it was an early data point on that scaling ladder for us. The next models we release will be an even greater point on the scaling curves, and we are really excited to show the world what we'll be able to produce.
And obviously you went from basically rebuilding the team, rebuilding the lab to this Muse Spark model in a very short amount of time. What is the biggest barrier from getting to that, the appetizer, to the next level? Is it, I assume it's not resources. You guys are spending a ton of money on this effort. Is it just simply time? Is it talent? Like, what's going to bring your models to that frontier?
Yeah, it's, we've talked about some of this in some of our public blog posts and whatnot, but it's about continuing to scale the data, the compute going into the models, as well as continue to scale with research. So continue to drive advances in, underlying research breakthroughs to continue driving forward the progress in the models, and building infrastructure to support all of this. This is in many ways a year where all of the labs are dramatically scaling up their models, and we are on, we think, a much faster trajectory to do so, because obviously we've been doing all this work over the course of the past year. But yeah, we need to build the infrastructure, we need to scale the data, scale the compute, train these large models, and show them to the world.
That's Chief AI Officer Alexander Wang speaking there at the Bloomberg Tech Summit. I've just been reading about Alexander Wang, Tom, a pretty impressive guy. I didn't know he was roommates with Sam Altman during the pandemic, and founded Scale AI as well. Which,
of course, then Meta subsumed, took over, essentially. It was essentially a takeover of Scale AI. And, of course, Alexander got very well compensated for that. A lot of the team moved over, and they made these massive investments. Meta was behind. Meta remains behind the likes of OpenAI, the likes of Anthropic, and the likes of Google in terms of the most cutting-edge frontier models. But Alexander has restructured the team and is trying to play that catch-up. But he's admitting they're still behind, and they've got a lot more work to do.
Impressive guy. Right, coming up on the programme, trouble brewing in private credit. We'll get the latest with the Andromeda Capital Management CIO and co-founder Alberto Gallo. This is Bloomberg. This is the opening trade. We're 30 minutes into today's session, and that AI angst that we've been seeing going around the world has now infected Europe. At the bottom of the sectoral basket is now tech, as it was at the start of the session, but we've also turned red across the benchmark European index. The Stoxx 600 now down 0.2%. Losses in Frankfurt, losses in London as well. Only the CAC 40 is managing to stay flat this morning, but we're following the losses we saw on the Kospi, down about 5.5% at the moment, and as we're expecting to see in the US session later, US futures down about 1.25% as things stand. Tom, what are you seeing under the hood?
Yeah, and as you look at volumes, there is a suggestion down, 30%, 40% right now, volumes versus that 20-day average, that maybe some investors are sitting this out until they get more clarity, not just on AI and geopolitics, but of course on the macro event of the day, which is non-farm payrolls and jobs out of the US. In terms of the breakdown across the benchmark Stoxx 600, you're seeing 328 stocks in positive territory, the rest feeling that downside pressure. On the upside then, Raspberry Pi coming through with some earnings that have revived the spirits of investors in that company. So rallying really strongly on the back of that story. Of course, these handheld computers listed here in the UK, hand size computers up 17.5%. So Raspberry Pi getting a big lift. Evoke is currently also gaining around 5 points, up 14%. This is the online casino, and so that is rallying as well. AbbVie and Abivax, this had been beaten up a bit at the beginning of the week. It gained yesterday and it's gaining again today. Maybe the sell-off at the front end of the week was a little bit too much for some investors, and they're moving back into Abivax, and that is gaining up around 7%. On the downside, let's flip the board and have a look. There's some deal-making news, or at least announcements that deals will not be happening. Apollo is not going to be pursuing a takeover of Bodycote, and so that company, in terms of the industrial heat story here in the UK, down 9% on the back of that. Air France cut at Barclays, so under pressure, the airline by 1.5%. And ASML, this is part of the broader sell-off that we're seeing in terms of the tech space that Lizzie was mentioning, and ASML is a victim of that today, down 2.5%. A year to date, of course, that stock has rallied pretty strongly, but down 36 points in the session today. Lizzie.
Here's what else you need to know this morning. Brent crude edging higher as we see no signs of progress, in fact, in US-Iran talks after the worst burst of violence in weeks. The Tehran-backed Hezbollah militia has rejected the US-brokered truce in Lebanon. Meantime, Reuters is reporting that Oman's Mina al-Fahal terminal has suspended oil loading following an explosion near one of its mooring berths. Elsewhere, India's central bank has announced a raft of measures to support the currency after it plunged to a record low, while keeping its benchmark interest rate unchanged to support the economy. Separately, the government announced a reduction in capital gains taxes on bond investments by foreign institutional investors. And the European Union's trade envoy, Maroš Šefčovič, has told his Chinese counterpart to address the, quote, unsustainable trade imbalance between the two countries. This as the European Union reassesses its trade defence tools and discusses new instruments to cope with China's export of good and state subsidies. China has pledged to retaliate if the EU proceeds with new restrictive trade measures. Tom.
OK, let's turn to what's happening in private credit. Some really fascinating moves in terms of the redemption stories, the requests for withdrawals, but also the rally that we saw in some of these names in the session yesterday. Blackstone, this is the detail, limiting redemptions then from its flagship credit fund, as we discussed yesterday, for the first time after investors sought to pull 10% of the shares. This is the latest firm, of course, to cap withdrawals amid a continued investor exodus across the space. Leaders in the space spoke about jitters in private credit at the Bloomberg Global Credit Forum, which took place in New York this week.
Institutional investors continue to make up 80% of our clients. Individual investors make up about 20% of our client base. And indeed, it's that individual investor segment where you see most of this redemption pressure coming from.
The private credit market sits at about a 40% loan to value, meaning it's underpinned by a significant amount of private equity. And so if you want to talk about stress in private credit, you have to talk about stress in private equity.
Credit has still languished, and we expect that to continue. Now, that's not to say that it can't have a better second half, but I do think there's some pockets of opportunity. But this is historically a tough time to be in credit.
Historically, a tough time to be in credit. Bloomberg credit reporter, meanwhile, Silas Brown, has been following all the twists and turns of this story. Silas, where do things stand right now? It was interesting that actually some of these names rallied pretty hard yesterday in the session, but the redemption story is still there.
Yeah, I mean, I think at the moment private credit is a bit like a Rorschach test. I mean, you make of it what you see, and I think that's why in the credit forum you see such a vast.
Is that the rabbit or the duck test?
Well, it can be both, yeah. So I mean, and I think you can see positive and negative signals signals quite clearly. What I would say about the redemptions, look, Blackstone capped at 5%. Cliffwater did. They're the first two to report. I think the strong expectation is that they all will start following suit. That's not that surprising, given the redemptions normally come in twos or threes. I mean, the first round of redemptions sparks the next round of redemptions. I think I'm very interested in the next quarter. If there's elevated redemptions next quarter, I think that sort of demonstrates that this is a sustained thing rather than an angst thing.
So it's too early to say that the golden era of private credit is well and truly over?
Oh, or too late. I don't know. I mean, one or the other. Yeah. I mean, look private credit is somewhat... the elasticity of the term private credit is such that I think golden age... they're trying to fund AI. They're trying to look into data centers. I mean, that period perhaps is a golden age. I think the period of leverage lending... which was prompted perhaps by elevated rates in 2021, 2022. Yeah, I think that's probably done a death.
Silas, thank you. That's Bloomberg's Silas Brown. Let's get more, though, on this topic. We can speak to Alberto Gallo, Chief Investment Officer over Andromeda Capital Management, also, of course, the co-founder. Really good to have you with us.
Morning.
Alberto, I wonder if you think that there are going to be more of these reputational issues spiralling again. We had a quiet period between March and June, but as Silas says, it's been ramping up again. Are we going to have more redemption requests keeping climbing?
I think at the core of the private credit equation is a broken promise. The idea that you would generate double-digit returns with very low risk for investors and give these safe yields. In reality, the returns have been in the mid to low single digits in the good times. So this is over the past 5 years, where defaults were low, there was plenty of liquidity, and everyone could refinance. And if you look at the last few quarters, the annualized returns of some funds are in the low single digits. So this is, again, in a good credit environment. We still have no hikes from the Fed. We'll see later in June and then in the next few months. But inflation is rising. So this extended credit cycle that we're living through at some point will come to an end. And right now, before the end, we already have 10% of companies in private credit funds that are paying in kind. So they don't have enough cash flows to pay coupons. And 40% of companies are negative free cash flows. So in other words, you are betting on a giant lever that has been pushing up the CapEx effort for AI. But all you are gaining is a few basis points. You're not getting the upside.
But is it kind of healthy to clear out some of the retail investors, that they're cautious now, and then you're left with the institutional investors who know what they're dealing with?
Maybe, maybe not. I think retail investors should not have been there in the first place, ever, because there is lack of disclosure on the underlyings. And I think that there's been some appetite from institutional investors due to the fact that these funds don't have mark-to-market. So what AQR is called volatility laundering. But what we have seen mapping the universe is that, of course, there will be good and bad managers, but you have many ways to delay losses, to reduce transparency, given the freedom that you have as a manager to not mark to market this loan, and different loans have different prices with different managers, or to delay losses, etc. So at some point, though, the bill comes, and it comes when inflation is high, when the Fed needs to hike. And, we're getting there.
I want to get your take on that. But when the bill comes, are you suggesting that there is potentially a systemic risk from what we're seeing in private credit, or is it just a broader picture in terms of cost of capital going up in a higher rates environment?
That is a great question. So regulators so far conclude that it's not systemic yet. The ECB did a chapter in the last Financial Stability Review earlier in May on private credit. The IMF has done some work on it. But the ramifications are there, and they are actually in a different, they go a different way from the 2008 crisis. So here the risk is really through the insurance sector, not to the banks. And remember, life insurers, which are controlled by the same firms, by the private equity firms, are $1 trillion in balance sheet. Private credit is around $2.5 trillion. So we're talking about, order of magnitude size, which is similar to what subprime was in 2008.
You're concerned, higher inflation, higher rates. How do you position for that? Does it derail more sustainably, more substantially, the AI rally?
So look, right now, credit is priced for perfection. We have the lowest spreads in 30 years. We had a lot of inflows. Some of them went into private, some of them went into public. So you want to be nimble. If you're looking at credit, the values in dispersion, the values in the volatility of credit, there are some pockets of opportunity for sure. But what you don't want to do is to be long or turbo long, for a number of years. So you want to be nimble. There's two things that happen right now. If the economy is too hot, so you have inflation above 3, the Fed hikes, then you're losing because interest rates will rise and the cost of refinancing will rise. If the economy is too cold, AI, for example, is very successful and you have losses in the job market, then also some firms would go out of business. So you're essentially selling this put option, but you're also selling a call option by being long credit at 7-8% yield. If things are going really well, you're going to have higher rates. If things go a bit less well, you're going to have higher spreads. It's not a great thing to be locked into this sort of investment right now.
Yeah, so what's the bigger risk then? The inflation story or the debt that's tied to AI?
We think right now the bigger risk right now is that the economy is getting a little bit hotter in the U.S. So there's a lot of capex, there's a lot of investment. Deregulation is going to add $2 trillion of bank balance sheet size to the U.S. bank. So right now, there's a lot of institutional attempts to prolong the cycle, to expand credit supply, even though the Fed might reduce their balance sheet a little bit over time. The hikes or the balance sheet reduction are not enough compared to bank deregulation. So we're still overheating the cycle. But after elections, things might change, and we might have less fiscal spending.
And so when we do finally get this sustained default credit, cycling credit, is it that we're underestimating how bad it's actually going to be?
It's going to be bad, but it's going to be bad in private because in the last 10 years, most of the growth in credit happened through private markets. The public credit market only grew by 5%. So what happened is that all the firms that couldn't fund in public markets, the firms that were a little bit more opaque, a little bit more levered, that we didn't want to lend to, they went to private funds. And private fund notional size went up 3.5x. So from a few hundred of billions to 2.5 trillion. So that's a lot of adverse selection. And 40% of that in the U.S. is tech, 40% of that is negative free cash flow. So we will see defaults and restructurings both in public and private markets. But I think that the worst of the concentration of risk is in the private market.
What are the implications for Europe?
Well, there are cross-asset implications. So obviously, Europe is more hit by the current situation, by high energy prices. But Europe has less software loans, has less of that, capex going on. So
does that make Europe a bit of a haven?
So surprisingly, Europe is now at the largest short positioning. So if you look at data from the DTCC, which looks at all the data on credit default swaps, the investors have been as short in Europe as they have ever been in the last 15 years. And that's because of geopolitics. So in Europe, spreads are tight everywhere, but in Europe, there's a lot of unloved assets. There's unloved assets in European high yield. There's unloved assets in Ukraine, for example. So investors have gone very long Trump and MAGA and all the assets that are linked to that policy. Europe has been a little bit left behind, which gives you a little bit of cushion. And in fact, you can see that on down days, European credit is pretty stable. So we're not saying that it's an amazing opportunity, but there's some interesting pockets in Europe that I think are very crowded in the US. It's harder to find.
Interesting. Maybe the baby thrown out of the bathwater in Europe. Maybe some opportunities then in the credit space. Alberto Gallo, thank you very much indeed. Chief Investment Officer, CIO and co-founder of Andromeda Capital Management. Coming up, talking of Ukraine, Ukraine's president has proposed peace talks in a letter to Russia's Vladimir Putin. We're going to bring you the latest on that open letter. That is next. This is Bloomberg.
Welcome back to the opening trade. 47 minutes into today's session, and you can see the Stock 600 has been pulled ever so slightly to the downside. The AI angst going around the world. We saw it in the US yesterday. We saw it in Korea this morning. And indeed, tech is performing negatively. Of what tech there is here in Europe today. The DAX in Frankfurt down 0.1%, and the FTSE flat to the downside as well. Gains, though, out of Paris.
OK, let's get back to a geopolitical story that has not been front and centre for us because of the focus on Iran. But today it is, because Ukrainian President Volodymyr Zelenskyy has proposed peace talks with Russia's Vladimir Putin in an open letter, saying Ukraine is ready for a full ceasefire during negotiations. President Trump welcoming Zelenskyy's initiative.
I'm glad that they're maybe talking about Mania. I think we had a lot to do with it. I know exactly what you're doing. But I think it would be great if they met. They should get it done.
OK, so Trump taking some credit for that. For more, let's bring in Tony Halpin, Bloomberg's team leader for Russian government. Tony, you followed the twists and turns of all of this from day one. What do you make of this offer from Zelenskyy? What does it tell us about Ukraine's position? What does it tell us about the likelihood of any meeting between the two leaders?
Morning, Tom. Yes, it's very interesting. I think President Zelenskyy with this letter is really trying to kickstart the process of talks again. As you've noticed, they haven't really gone anywhere since the Middle East crisis erupted, and that's distracted the attention of the Trump administration. And Zelenskyy feels he's probably come a long way since that famous meeting with Trump last year in the Oval Office where he was told he didn't have any cards. I think he thinks at this point that Ukraine does have some rather strong cards, and he wants to play them to try and lure Putin into a meeting and to sit down and negotiate a peace deal. And he's very clear he wants the US involved, but he also wants the Europeans at the table too. And there are European leaders who would like very much to be at that table.
And Tony, let's talk about what happened in Washington. The Democrats winning this vote in the House, support from 18 Republicans to back aid to Ukraine and sanctions against Russia. How important is that vote?
Yeah, I think it's a further signal. There are plenty of Democrats, and now it seems a few Republicans who are pretty hostile to Trump's approach to this war, that the administration basically tried to act as a mediator, viewing them more or less the same. Democrats were pretty clear that Ukraine was the victim in this war and Russia and Putin were the aggressor. And they're signaling now that, look, we want to see support for Ukraine and we want to see tighter sanctions on Russia. It's still not clear whether Putin will take up Zelenskyy's offer. In the past, he's refused to meet Zelenskyy unless there's a deal on the table. And he has also rejected the idea of any ceasefire while talks go on. He's simply said, look, that's just an opportunity for Ukraine to rearm. And it's clear in Washington that there's quite some support for continuing to bolster Ukraine.
OK. We'll see if that support solidifies, won't we? Tony Halpin, thank you very much indeed with that update. Let's look ahead at what else we are watching throughout the day then. The EU and Western Balkans Leaders Summit is taking place. EU Commission President Ursula von der Leyen will be speaking. No doubt Ukraine will be part of that conversation. At 9:30 a.m. UK time, meanwhile, we're going to get the BOE's Decision Maker Panel Survey. So some colour there and some detail in terms of thinking at the Bank of England and key jobs data, of course, out of the US. This is the big macro event with non-farm payrolls and unemployment data at 1:30 p.m. UK time, and our US team will give you all the analysis and live coverage of that. And at 4 p.m. UK time, UBS CEO Sergio Ermotti will be speaking at the Swiss Economic Forum. And at 7 p.m, back to central bank governors. 7 p.m. UK time, Bank of England Governor Andrew Bailey pulling a light one on a Friday evening and speaking in Scotland, Lizzie.
So that's what's ahead today. I want to talk about last night, though. I want to bring in our Markets Live executive editor, Mark Cudmore, because you both were at the M Live event here at the Bloomberg European headquarters last night. I wasn't in the room, but I did watch it on the terminal. What was the mood, though, in the room, Mark? Was it bullish, bearish?
I was struck by the fact that people are still majority bullish the AI bubble. Like, everyone acknowledged the risks. But, for example, we did a kind of poll about when do you think the AI bubble will kind of blow up. And most people went for next year, first of all, being when it ends. And, you know, it was only about half that think it ends badly. So half basically were like, you know, but if you add up the people who thought no bubble at all, or it kind of ends, you know, pauses or deflates moderately, that was about half the room. And I found that interesting. And then, so not only are people not as concerned as I thought about AI, but you certainly noticed it as the panelists, apart from probably myself, who was probably the most bearish or worried, people were like, while acknowledging the risks and that we're kind of loath to sound too bearish because, this is the big moment to buy AI, it's the big boom time, I have to say I came away feeling more worried. I'm like, I was the most bearish. Maybe I'm not bearish enough.
You're like Michael Murray.
You were clearly the most bearish, I think, at least in terms of those who vocalised their views. Because you made it clear, you think the bubble bursts this year.
Yeah, I do.
So in terms of this year and the timing, as we think about those OPIs, do we have to digest the IPOs first? Is the IPOs something of a catalyst for that potentially? So, I mean, how does the IPO story play into your view about the AI bubble bursting, or does it not?
The idea I was kind of talking about last night was this, that I think that we might see some last stage of insanity around the SpaceX IPO because only 5% float out and 30% going to retail. All the passive index have to chase it. You're going to see the stock just multiply in price. It's already IPOing as one of the largest companies in the world. It could go a bit crazy and strange. Now, I've heard, actually, I should have validated before this came on the show, didn't know I was going to get this question, but I thought I saw a story last night that maybe the S&P is not going to fast-track SpaceX in. And I don't know if that's a definite decision now or not. But
that is a decision they
That's a definite decision. So it's not in all the indexes. So maybe that's less extreme in the passive index flows, but they still, going into the Nasdaq, you've still got some passive index flowing, which is quite interesting.
So when you see days like this where the Kospi is down 5.5% now, 7% earlier on, do you just think that that's a step on the way to what you're seeing, and actually it's kind of healthy maybe, or that it's healthy that people are taking profit?
It's definitely not healthy. This is my point last night, is that I don't know the exact timing, but I said, and I feel we're in this broken market's endgame. Now, how long does that endgame last? I don't know, but in 2008, it was clear the market was broken all year. But I was an EM trader at the time. Most emerging markets made fresh record highs in July 2008. Oil was trading up at $150 a barrel because, we're still rising. With the ECB hiking rates, right? So the market was clearly broken. I know the stock market peaked in October 2007, but yet most assets were trading as if, it's okay, it's very isolated. I feel that's like we're in that end game now. And how long does that end game last? It could last another 18 months. I just don't believe it. To me, I think we're close enough to the end game that if you tell me 6 months, fine, I'll give you 6 month. But really, I think it's much sooner. I think it's the next... I think it's, we're talking weeks to a couple of months. Or maybe this is it. I don't know. I really think we're towards the end game where people are starting to realize this is all frankly ridiculous. It's going to be like one of the stories in that, what's that book, who's written the guy, Popular Delusions and Madness of Crowds? I can't remember the guy who wrote it, and he wrote it about 100 years ago, but it's brilliant about tulip mania and stuff like this. This will be one of those incidents, the South Sea bubble, the tulip mania. This is going to be in there.
Despite making me sweat and the pessimism and the bearish take from Mark, it has been a pleasure having you this week. What are you doing this weekend, Mark? I mean, you've been...
Of course, Friday afternoons, Borough Market drinks. It's, it's always the case, and then flying back to Singapore.
OK, well, it's been fantastic to have you here, Mark Ardmore. Thank you very much indeed with that bearish prediction around the AI bubble bursting.
Well, let's take a look at what's actually on the diary for the weekend. We've got the NBA Finals Game 2, Tony Awards as well, the F1 Monaco Grand Prix, Primavera Sound in Barcelona, and also a bit of tennis, Roland Garros in the finals.
What's top of mind for you then? That's a good rundown for the weekend, isn't it? Take your pick.
I'm
Sport, music.
Take the temperature of the UK housing market, Tom.
Oh, are you?
Yeah,
you're in the market.
Yeah, well,
it's a challenge time, isn't it?
It is, exactly. On the ground reporting.
OK, we'll get your feedback then on Monday. We all hope you have a fantastic weekend, of course, after another wild week for these markets. We'll be back with you, of course, on Monday. Do not miss the debut of Bloomberg Money Today, by the way, at 5 p.m. London time. Join Scarlett Fu and Tom Keane for spending and investment strategies to help make smarter decisions with your money. The Pulse is next. This is Bloomberg.